Alright, let's take a look at Module 1, Price Action Basics. The definition of price action. Very simple. Price action is the movement of price. When you see the candlesticks on a chart that's built the entire chart, it's just simply those price movements. It is the fundamentals of trading. It's the foundation. The candlestick is an important tool to visually analyze price action. The historical movement of price is displayed in candle patterns on the chart. Analysis of these patterns reveals order in the random movement of price. Support and resistance, breakout, and consolidation are just some examples of price action behavior. Candlestick patterns such as a harami, engulfing, and doji are all examples of visually interpreted price action. Price action is the recent price activity. It's just the history of a currency pair. Price action is based off the price only. Price action is the movement of price. It is the source of all indicators. So let's look at some definitions here. Support is an area that price cannot go below. Resistance is an area that price cannot go above. Oscillating or consolidation is when price is bouncing off support and resistance multiple times and cannot break through to new highs or new lows. So let's look at price action. On this chart, just take a glance at this chart. What do you see? Here's what we see. When you have a trained eye, this jumps off the chart. Look at this number 1 area. This is where support is established. It comes down and it can't go any lower. That's called support. Number 2 is just a small example of consolidation. That's where it's just channeling. See, it sets up a low, a high, a low, a high, and it just can't move outside of that. Look at 3. This is where it breaks through this area of support. It breaks through that. That's called a breakout. Number 4, look, it retests. This is support. This is support. It's broken. Now it becomes resistance. This is the fundamental key element that I want everyone to learn. Support, once broken, will become resistance. And if you understand that, you can trade that. That's number 4. Resistance is established. Look, it comes back up and again is rejected. Okay, then number 6 is a breakout. Again, look, it comes back to this area and it punches through to the upside now. But look at this yellow area, how price is respected as support, 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 breaks, becomes resistance, resistance, and then breaks through, and look, it comes right back and stops there again. Very fundamental price action to study. So what's support? Price action support. Look here, number 1, this is where support gets established. It stops, and then it comes back again. It's like a retest. This is confirming this is support. Let's look at resistance. Here, resistance is established. It's broken support, comes up as resistance, and then later it swings back up through there, and that confirms that that is a level of resistance. Price bounces again. Consolidation. Consolidation, price is trading in a tight range. So here's a box where it kind of comes in, sets up a low, can't go lower, sets up a high, can't go higher, and then it breaks up and out of the top of that box. So this is an area, and every time frame is different, understand. You could look at this on a 15-minute chart. This could be a 1-hour chart. It could be a daily chart. You're going to see these same patterns across all time frames. So price action plus, this is the concept. Price action is good if you just draw your support and resistance lines on a chart. But when you combine price action with market timing, that's even better. Things like the Asia session, the London session, the US session, opens and closing of those sessions. When you include price action with your market timing and the thermal grids, that is your best, highest probability trading opportunities come when you align those 3 elements. So let's look at some more price action behavior. If there's a breakout of an established support, ideal on a 15-minute chart is maybe 15 to 20 pips. Price is going to stall. Number 2, you'll see a doji oftentimes. Red or green, doesn't matter. What happens? Price floats up across a couple candles, touches that level, and then number 4, it just drops from that level. It'll do this all day long. So here's your homework. I want you to look at some Euro US dollar, US Swissy, US CHF, the Great Britain pound, and the US dollar. Take some 15-minute charts, print them out, or just go on your screen, whatever you're comfortable with, and start drawing support and resistance lines. Look for areas of resistance, areas of support. It won't be exact, but it will be an area within 2 to 3 pips. And then look for breakouts, dojis, and retests. You'll be amazed once you're aware of this. Once you're trained with your eye, you will start to see this all over the place. So let's analyze this. February 8th, 2011, Great Britain US dollar, 1-hour chart. Note the timing of the sessions here. This is during the London and US session. Number 1, price stalls at a previous support. Okay, so look at here. On Friday, here's a low. Here's Monday, here's Tuesday. It's coming right back down to this level. Now, what do? Well, price consolidates at the black support level. If you drop down and really analyze this, you see how it's slowed here? It's chopping. It doesn't know which way to go. There's no trend. It's slowing down. Okay? Now, price, boom, one candle, it breaks through. It breaks the support. The secret is hidden in the next candle, because this is going to tell us what happens. Watch. The next candle does almost engulfs. It has price goes down, but immediately it pushes almost all the way back up to the black line. See that? Price immediately rejects it. It engulfs the breakout. Very often you'll see price pull back near the center of the 2 candle bodies and then explode up. You see this often. Watch. Here's the price behavior. 1, price is either going to go up, price first pulls back near the middle of the 2 candles, or 2, price will go down, price will make new lows, and it'll break through this. You got 2 options. So there's the middle of the candle area, and here's the low. So here it is on a 1-hour chart. Price stalls at the previous support. 2, price does break below support. But let's take a closer look at what happens. Price stalls at the support. It breaks below. Drop down to a 15-minute chart here. And let's dive into what really happens here. Now look at this. Price breaks support. The next candle is immediately rejected right back up. And you'll often see a wick. Could be on the first candle, could be on the second. But usually you'll see a wick to the bottom. There's 2 options. 1 is price will pull back near the middle of these candles. Price will make new lows. So 1, price breaks support. 2, price is rejected and engulfs the breakout. 3, price pulls back near the midpoint. Price powers up. Let's take a look. See what it did? Breaks, rejects that break through the bottom. Price pulled back near this midpoint, even a little bit deeper, and pow, it powers up off of that. That's the price. This is the price action. This is a common pattern. There will be a million variances of this. The wick might be here, wick might be here, it might stop at halfway, might go a little bit deeper, could go way down here and then go up. I mean, there's different variations, but the concept I want you to understand is that when you see this at the tops or the bottoms of price areas, this tells you, it gives you insight to which way the market's going to go. And if you understand that, you can trade it. If you can trade it, you can make pips. Price goes down. If it goes below this reversal setup, it usually goes down hard and fast. Notice it didn't break those levels. So here's your homework. Print out these charts, Euro US dollar, USD CHF, Great Britain US dollar. Go look at a 15-minute chart. Draw your support resistance, look for this break and engulf pattern and pullbacks. You'll see this across many time frames. I see it on a 15, I'll see it on a 30-minute, a 1 hour, and a 4 hour. Now here's some parallel strategies for you to understand and watch. When you see these patterns line up and maybe two pairs are setting up in almost the same pattern, this confirms the setup and actually helps you make your decisions. The parallel strategy identifies two currency pairs in agreement on price direction. There are three primary parallel pairs. There's the Great Britain US dollar and the Euro US dollar. There's the US dollar against the Swissy and the US and the yen. There's the Aussie US dollar and the New Zealand US dollar. These three primary pairs run together. Inverse strategy. The inverse strategy identifies two currency pairs that do not go in agreement on price direction. In other words, one goes up, one goes down. These are the three primary inverse pairs: Euro US dollar and the US Swissy, the Great Britain US dollar and the US yen, the Aussie US dollar and the US CAD. Here's a better look. Euro US dollar goes up, Great Britain US dollar goes up. These are parallel. If the Euro US goes up, the US Swissy should go down. That's an inverse pair. If the US Swissy goes up and the US yen goes up, that's parallel. The Aussie New Zealand goes up and the New Zealand US dollar goes down. These are inverse pairs. And finally, the Great Britain US dollar goes up, the US yen often goes down. Those are inverse pairs. Now, there are aberrations, we call it, when they misbehave. The euro's going up and the pound goes down. It's confusing. The Euro US goes up and the US Swissy goes up. Uh-oh, they're not supposed to go together. There's the US Swissy and the US yen. They're supposed to go together. One's going up, the other one's going down. Or if you see the Aussie dollar New Zealand going up and the New Zealand US is going up, that's an aberration. If you see the Great Britain US going up and the US yen is going up, that is an aberration. So you can, again, use your price action and this alignment across two or more currency pairs to help you make your trading decisions.